Hey everyone, and welcome back to Am I Catching a Falling Knife, the podcast where we dig deep into those stocks that have taken a tumble, trying to figure out if they're a bargain or a bust. I'm your host, Dave, and today we're lacing up our sneakers and tackling the athletic apparel giant Under Armour, ticker symbol UA. UA has seen a pretty significant fall recently, plummeting a full 23.45% over the last few days. That's a drop that definitely makes you wonder, is this a prime opportunity or is there more pain ahead? So, what's behind this steep decline? The dominant market narrative for Under Armour right now revolves around a tough balancing act. On one side, they're trying to cut costs and improve profitability, which sounds good, right? But on the other side, they're battling persistent revenue declines, especially here in North America. Couple that with weak future guidance and some recent analyst downgrades, and you've got a recipe for market uncertainty and, well, a significant price drop. Before we dive deeper, let's quickly recap what Under Armour's all about. This is a global company designing, developing, marketing, and distributing athletic performance apparel, footwear, and accessories. They're all about innovation, strengthening brand relevance, and boosting efficiency. Looking at their latest annual revenue, they brought in around $5.16 billion. Most of that, about 65.8%, comes from apparel, with footwear making up 23.4%. Geographically, North America is their biggest market by far, accounting for 59.1% of their revenue. But interestingly, they've got negative free cash flow, sitting at nearly negative $200 million and about $1 billion in total debt. Their gross margin is respectable at 47.9%. Now, let's connect that market narrative to the financials. The big question is, how much could this narrative actually impact Under Armour's earnings? Our analysis points to an estimated 15% decline in quarterly earnings, with a confidence interval ranging from a 10% to 20% drop. So, how did we get there? First, the narrative explicitly points to persistent revenue declines, particularly in North America, combined with weak future guidance and analyst downgrades. This is a clear signal of a big hit to their top line, especially in their most crucial region. Given the severity of these descriptions, persistent and weak future guidance, we've estimated a 10% revenue decline specifically for their North American segment. Remember, that's where almost 60% of their business comes from. So, if North America, which accounts for 59.1% of their total revenue, sees a 10% drop, that translates directly to about a 5.91% decline in Under Armour's overall total revenue. Now here's where it gets interesting because of something called operating leverage. Under Armour has a TTM gross margin of 47.9%, and many of their operating expenses, like administrative costs, tend to be relatively fixed in the short term. This means a percentage drop in revenue can have a magnified negative impact on net earnings. Plus, they're already struggling with negative free cash flow. Considering all this, we've applied an earnings sensitivity multiplier of about 2.5 times the total revenue decline. When you apply that multiplier, 5.91% total revenue decline multiplied by 2.5, you get an estimated 14.775% decline. Rounding that up, we arrive at our final estimated impact of a 15% decline in their quarterly earnings. The uncertainty in quantifying those qualitative descriptions like persistent decline is why we have that confidence interval, but the direction is pretty clear. So, with that potential earnings hit in mind, what does it mean for the stock's actual value? To figure out what this stock is really worth, I'm looking at it from two angles, using data I pulled from finviz.com. As of now, UA's trading around $5.19 a share, with a market cap of $2.27 billion. First, I ran a discounted cash flow, or DCF model. This model helps us estimate the intrinsic value of a company based on its projected future cash flows discounted back to today. Our base case DCF value, assuming a growth rate of about 12.9% for the next 5 years, a discount rate of 9.5%, and a long-term terminal growth rate of 2.5%, comes out to about $5.19 per share, very close to its current trading price. However, when we factor in the impact of our market narrative, that estimated 15% decline, our narrative case DCF value drops significantly to around $4.15 per share. That's the value when we bake in the expected headwinds. The second method is a bit simpler, a PEG-based valuation. PEG stands for price earnings to growth ratio. It takes the PE ratio and divides it by the earnings growth rate. It's a quick way to see if a stock's valuation is reasonable given its expected growth. Based on UA's current PE of 22.51 and its estimated 5-year EPS growth of 12.93, our PEG-based fair value comes out to approximately $4.46 per share. This tells us that even without a deep dive into the narrative-specific impact, the stock might be a bit overvalued at its current price based on its growth prospects. So, if the current price is $5.19 and our valuations are coming in lower, what are the potential buy levels where UA might start looking attractive? Based on this analysis, I'm looking at key levels around $440, then potentially $400, and for a deeper discount, even $250. These are the points where the stock's value aligns more closely with our revised earnings expectations and simpler valuation models, offering a better margin of safety if you're thinking about catching this knife. All right, that wraps things up on Under Armour. Remember, this is a company working through some tough times, and the market is reflecting that. Now, as always, here on Am I Catching a Falling Knife, it's crucial to remember that this podcast is for informational and entertainment purposes only. This is not financial advice. Investing involves risks, and you should always do your own thorough research and consult with a qualified financial advisor before making any investment decisions. Thanks for tuning in. I'm Dave, and I'll catch you next time as we continue to explore the opportunities and pitfalls in the market.